The California State Teachers Retirement System, or as it's known, Calstrs, is the second largest U.S. pension fund at $242 billion. It plans to increase its allocation to private equity and real estate assets as it aims for 7% annual returns. I recently talked with Chris Ailman, the fund's chief investment officer, about reaching that goal amid a backdrop of ultra-low rates.
The low bond yields are a heck of a challenge. Negative interest rates, I mean, it's not in the textbooks. So investing in the USA and U.S. interest rates, I think we can balance the portfolio and make the 7 over long term.
So, Chris, I was looking at your allocations, and currently private equity stands at about 9%, 8.8% of the portfolio. Your target allocation is 13%. How are you planning to get up to that 13%?
The answer, Lisa, is we're a steady pace investor. So we're going to be allocating into private equity as we have for the last couple of years on a steady basis over the next few years. We're also going to be looking at, as a lot of people, co-investment opportunities, and if it comes up, a secondary investment where partnerships we might be in now become available from other people. We'll look at those as a way to buy into the market and increase our exposure. We're not going to chase that 13% target. We're investors, so we want to be a steady investor over time, spread out over the vintage years as best we can.
I want to switch gears a little bit, Chris, from private equity to real estate, because that's another area that I believe you're thinking of increasing your allocation to. Currently, it's about $32 billion of the overall portfolio. How much do you plan to increase that?
Real estate right now for us is about a little over 13.5%. At our asset allocation that we're going to be discussing here in November, the board is likely to raise that long-term target to as much as 15%. We're not going to rush into real estate either. This is a very frothy market, so we're going to take our time, probably actually be a little bit of a net seller for the next year or so, and then get back into the market over time as we think prices might be reasonable. When you look at cap rates, particularly on the big gateway cities, New York, Boston, D.C., out here, Los Angeles, San Francisco, Seattle, prices are through 2007 prices. So most of what we've done to date has been build to suit, a little bit of development, a little bit of property improvement. And what we've really found in real estate is buy and hold.
The return objective for the real estate segment is 7.7% versus 5 to 6% kinds of returns that you've gotten from the portfolio. So how is that going to sort of change over time, or is this going to be basically sell, try to get some dry powder, and then deploy it if there is some sort of downturn or correction?
Well, if I could time this market, I definitely would try to do so, but even Sam Zell has found that's a bit challenging to do. We're going to have dry powder. We're going to be an investor and look for opportunities. That's an area where we've actually found, because real estate is so diversified and so local, we've actually found it valuable where we own a couple of real estate operating firms, so we're able to get into the business of being a general partner and then move the capital in and out as we see opportunities in the gateway cities, the secondary cities, and then pay attention to the population move.
So where do you think is the biggest opportunity within real estate, both when it comes to the type of housing as well as location?
Wow, real estate right now is fairly priced in almost every single category. We recently liquidated a senior housing portfolio because that area has gotten so oversaturated. Apartments have gotten oversaturated. I'm amazed to see the number of cranes going up in terms of construction in some of the major cities. So for us, it really is all kinds of specializations. We've looked at student housing as an interesting area, affordable housing, particularly out here in California, as an interesting area. We've been doing some development where we're taking development risks, particularly in the medical field, office buildings that are really designed for specific uses. We have a very major development that's worked really well for us up in Cambridge, in Boston, and in other locations of trying to be very targeted.
Chris, I know that you have performed better than other public pensions if you look at the averages, but pensions have steadily been lowering their returns expectations from about 8% in 2001 to 7.2% now. They're still missing it, or they have over that period. Are you concerned by some of the risk-taking behavior that you're seeing by some of your peers?
I am seeing some people move in different risk parts of their portfolio to make up for that low fixed income return, and I think that's where everybody has to be careful. When you look at corporate debt, you got to pay attention to covenants. The bottom line in investments is always true, Lisa. You've got to do your due diligence and you got to do your homework.